Okay, so this is the third video of my comprehensive guide to getting you started from a beginner to hopefully knowing what you're doing in the stock market. This is a 12-part series, and this is the third one. If you haven't checked it out yet, then I do really recommend you start with the first one, because I think that would be really helpful. And it's a progressive series, so it'll start from really beginner knowledge and hopefully just growing and growing to eventually looking at the stats and figures and really analysing stocks so you can really understand what you're buying. So check out the first one, I'll add the link here and in the description. And if you've already seen it, then great. We're going to continue on from the last video. And sorry that video was a bit long ago, but in case you've forgotten, we're looking at just understanding what areas you can go through to actually try and find stocks that you want to invest in. So now obviously you understand how to do that, and perhaps you've looked around and you've seen different stocks that you think might have great potential to grow. So now we're going to actually jump in and I'm going to show you the way I use to dive in and actually analyse these stocks that I think are worth looking into. To do this, I use a site called Yahoo Finance, and the main progression of the next few videos of this series is going to be just showing you through the whole route of how I actually analyse these stocks. So in this video in particular, as the video suggests, I'm going to go more into the idea of the first few figures that you look for to try and understand the value of a stock, and the basic areas of just knowing what the share price is, where to find it, how to look at the charts, and just get a brief sort of overview of how it all looks, just so you can kind of know what you're doing on there to begin with. But the main focus, we'll be looking at these valuation figures, because this will be the first thing you want to look into. Obviously if you're looking at a stock, there's no point wasting time if it's way overvalued, and if you see it undervalued, then perhaps that warrants more of an interest to want to invest into it. So just a forewarning, this is going to have a lot of numbers and then probably a lot of terms that you haven't heard of before. I'll try to explain it in the most basic way possible, just because this is video 3 and we're building into this. So I understand maybe I'll go a little bit quick, or I might have missed bits that could explain things a bit easier for you. And that's super understandable, and I'm here to help. So if you have any questions, please do ask me in the comments below. I may even elaborate on things and actually make a new unique video if you have an interest for it. I mean, I'm super interested in this stuff, so it's not a problem for me. So if you want me to clarify anything, or you'd like more information on a certain aspect, just please do give your feedback in the comments, because I'd really appreciate it, and I'm always keen to be in contact and help you out, so let me know. So without further ado, I recommend you get a pen and paper out, because there's a lot of things to take note of here, I think, and you may need to stop and repeat certain areas, but that's okay, you'll get there eventually. So let's jump onto Yahoo Finance and let's crack this open. Okay, so this is Yahoo Finance, and this is the main analysis tool that I use when I'm trying to find stocks initially. So let's jump into it and let's just choose a random stock and start looking at the numbers. So I'm just going to go for Facebook. It's a well-known company, and hopefully pretty much all of you can relate to it, so you'll know kind of what we're looking at here. Here's the first main section of the stock analysis area. So we just typed in Facebook, and here is the company name, and here is a little symbol saying FB. It's normally between 2 to 4 letters, and it's called the ticker symbol. And this is basically just a small abbreviation of the company, so it's easily analysed. Just a note, for the US companies, normally it's just a normal ticker symbol, and then if you're trying to find companies, say, in the UK, they'll normally be a little bit extra afterwards, so for the UK it would be .L at the end to mark London Stock Exchange. So, for example, if I'm trying to look for BP, which is British Petroleum, a UK company, I'd have BP.L, and that would help me find it on the London Stock Exchange. So let's go back to Facebook anyway. Okay, so now this number is underneath here. This is the share price. This is the current share price of what the value of the stock is right now per share. So this is saying it's worth $266. And as you've seen already, this updates and just corrects itself all the time. People are constantly buying and selling shares, especially in a big company like Facebook. And next to it, this is the action for the day, just this day. So it's saying that it's gone down by 0.76%, which is $2 in total. And it's changing all the time. And then let's bring our focus just over to this chart over here. So there's different tabs for each different time frame of the chart. And the first few of these are mainly useful just for traders, because you're seeing all these short, quick sort of fluctuations in what's going on. And this is normal because people are constantly buying and selling shares all the time. So in the short term, this is super unpredictable because who can tell what people are thinking when they're just trying to buy and sell within a day or so. But then when you go into the longer format, you're seeing actually the true interest of the investors for the company. So you see obviously that during the virus impact, there was a bit of a crash. This was obviously around January, December time when fears were starting to happen. So the price went down, and then obviously things were starting to look up. Investors were starting seeing that the situation wasn't quite so bad for this company. Obviously Facebook is not going to be super impacted by this. So then the price just shot up quickly again, and now it's completely back on its trajectory for where it was increasing for the past 5 years. And then this last hub, maximum, so you're seeing where it's gone from the whole time it's actually been a public company. So this is useful just to look at to get a good idea of what's been going on with the stock in the short term and in the long term. So now let's actually look at some numbers. This first one I want you to look at is the market cap. This is short for the market capitalization, and what this pretty much is just basically all the share prices of every single share all added together, and this basically forms what the value of the whole company is, with correspondence to all of the share prices added together. Obviously you're seeing here that it's $750 billion, which is a huge company, and you can tend to see this going up and down a bit as the share price fluctuates over time. So if the share price goes up and the number of shares in issue stay the same, then obviously the market cap's going to go up, so generally meaning that the company is getting bigger. Now, on the left here, these aren't so useful figures to look at. It's not really going to make a big difference to your investment, but just to run down quick on the most important bits. Previous close, that's what the share price was the day before, and open, that's what it opened at today. So obviously there's investors wanting to buy and sell overnight where the stock market isn't open. So when it opens, that's a reflection of what happened overnight. And then bid and ask is basically just the difference between how much it's going to cost to buy and sell. So just remember that when you're looking at the share price here, that's not going to be the exact price you're going to buy or sell the share. It's dependent on what the buyers and sellers of the share is willing to set at that price. So it's going to be slightly off. So if you're trying to buy, then generally you're going to be paying a little bit higher expense than that. And if you're trying to sell, normally it's a little bit lower. And that's just normal, so don't worry about that too much. And the rest of these figures is just saying how many shares are actually going in action today, how active the trading is, and the range of prices that's happened over the past day and the past year. Okay, so now let's get to the first real important bit. This first one I want you to look at is EPS. That stands for earnings per share. What this basically means is earnings, so the total profit that the company has made over the past 12 months, divided by the amount of shares that Facebook have. This basically means how much profit the company is making per every single share that they own. So for every single $266 share, the company is making $10. So that's earnings per share, and that's basically the building blocks of the first and probably most widely used ratio for actually looking at value and trying to understand how worthy a stock is, and that is the PE ratio. That stands for price to earnings ratio, and is basically the share price divided by the earnings per share. And this is a really good valuation ratio for everybody to look at really, because what it's telling you is how much are you actually paying compared to how well the company is doing in terms of making profits. It's the actual price of the stock at the current moment divided by the profits that the company is making. So here we can see that the PE ratio is 26.37, and generally this is a bit high. Normally, on average, a good PE ratio is normally 15 or less, but this does vary a lot between different sectors and companies. So the main real way of getting a good idea of what a good value is relating it to similar companies which are in the same sector or run a similar sort of business, because that can give you a good idea as to whether they're cheap compared to another company that's running the same way at the moment. But using a rule of thumb is a good way, so it's above 15, which obviously makes it on the slightly more expensive side. It's not too bad, but it is a bit more expensive. But one quick note to that, which we'll dive in a little bit deeper later on. If a company is expected to grow really fast, so meaning that their future earnings, their profits for the next few years are going to be a lot higher, then generally this can justify having a higher PE ratio, because that will mean the share price at the moment relative to how much they're going to make. If they're going to make lots and lots in the future, then that means the future PE ratio is going to be a lot smaller. So then that can justify paying a higher price now, because you know that it's going to be worthwhile in the future. And that's the PE ratio. And then the last few things here is just earnings date. That's basically when the earnings are reported, so when you can expect to find out how well the company's doing for each year. And then the dividend yield. Obviously Facebook doesn't pay a dividend, so it's not applicable here. But if you had a dividend paying company, then it will say how much percentage you're going to expect to make every single year from that company in terms of a dividend payout. Remember in the first lesson when I was talking about making an income from your dividend stocks? And that's what I mean there. That percentage here is how much you could expect to make each year. So here looking at BP, it's 6.08%. So that's how much you make each year from BP in terms of dividend payout, which will be cut up into quarters, and it will be paid out every 3 months. So effectively you'll be getting 1.5% of your overall earnings of that company every single 3 months. And that's basically this front page. That's the basic quick thing that you'll get straight up when you type into a company, and you'll get this face on. So now hopefully you can just understand what's going on with the chart and the first main PE ratio, and obviously understand what the share price is now and what's happened today. So now the next tab as you go along is just a bigger value of the chart. It's quite self-explanatory. If you know how to use the chart, then you can just dive in a bit deeper and see things a bit more detail there. Then the next one along is conversations. Take this one with a pinch of salt. Probably I won't read into this too much because anybody can type in here. They're just saying what they think about what's going on with the stock and stuff like that. But a lot of people don't really know what they're talking about. So trust your own intuition about what you're finding out about the stocks and what you're reading, and get knowledge from people you trust and from books and stuff like that, rather than these comments, I think. And then the next one. This is going to be the bulk of the lesson. And crikey, it looks like we've gone through quite a bit already, so it's probably going to be a bit of a long video. But these top ones, this is the real bulk of what I want to get into. So if you're going to concentrate for anything on this video, definitely concentrate on this. And then you'll see all the way down the stats. It just gives you all the main numbers that you want to look at to look on a company. And don't worry, it looks like a lot right now, but once you get the hang of it, and once you know what's good and what's not, and what to look out for and what not to, which hopefully I'll clear up all this for you today, then you'll be able to pretty much just breeze through it. You'll see different numbers and relate them to others, and then you'll just get a quick insight as to whether this company is worth looking into or not, whether it's of good value and whether it's actually worth thinking about more, whether you want to put your money into it. So here's the valuation measures. Take note. Obviously here we have the market cap, hit right here. And that's what we looked at before. Remember, that's the share price of all the shares added together to give a number of the total value of the company. And then below we have enterprise value, which is used in a few of these stats underneath. And it's basically just portrayed to be a slightly more accurate measure of the actual value of the company. Because here it takes into account all the shares in issue, but enterprise value is basically the market cap, minus the debt, and add the cash that they own. So it's basically all the company's shares, minus anything that's holding them back, so any sort of financial liabilities that they have, that obviously shouldn't be counted to actual making up the company size. So this is just another add-on that is just a good accurate thing to look out for. And now we're back down to PE ratio, which remember we looked at in the first page. And so we have two different PE ratios, the trailing PE ratio and the forward PE ratio. Also we spoke about the trailing PE ratio on the first one. That basically means the price to earnings ratio, so the current share price divided by the earnings per share, from the past 12 months of earnings, so the past 12 months of profits they made. And do you remember earlier when I was talking about how if a company is expected to do well in the future, then you can justify paying a higher price? This is exactly what forward PE ratio is for. This is basically the PE ratio, but for the next 12 months of earnings. So as you can see here, that the value here is a bit lower. That basically means that future earnings of Facebook is expected to be higher than what it is now. So that means that the earnings per share is going to be higher. And that obviously decreases the ratio because it's relevant to what the share price is now. So that means the current share price is more of value compared to how much it's going to be worth in the future, according to analysts. And this is why earnings dates are so important, because these analysts, they make up these numbers, obviously from a really good level. They've looked big into these companies and understood what's going on. But sometimes they miss the mark. It's hard to obviously predict the future. And so when these earnings dates come out, investors see this and they see, did the company actually meet these expectations of the earnings that the analysts were thinking they were going to make? And if they make them or beat the earnings, sometimes you'll see a massive sharp rise in the share price because they know that the future earnings is higher than they actually thought it was before. And on the contrary, if earnings are missed, if they are below what they are expected to be, then you'll see a sharp decrease in the share price because the company isn't doing quite as well as analysts were first expecting. So I'd take both of these PE ratios into consideration, because the current one is good to show you what's going on now, and then the forward PE is good for showing you what's expected for the future. So is it justifiable to pay a slightly higher price for the stock right now? And then the next one is probably my favourite ratio to go off. I followed this one strongly from a really good book called Zulu Principle by Jim Slater, and he really values the price to earnings growth ratio. That is the PEG ratio, or PEG ratio. And this basically means the current PE ratio divided by the expected percentage growth of the company for the next 5 years on average. So say if a PE ratio is 100, so it's a really high PE ratio, it's a company that investors really want to buy into, the share, so the share price is really high for what it's making right now. But in this case, you'd expect that the growth to be really high to make these investors obviously want to buy into this. And so expected growth for the next 5 years is something good, like 30% a year. So what you do is you divide the PE ratio, which is 100, super high, and then divide it by the 30. And then that will give you, say, around 3.3. And that will give you the price to earnings growth ratio. And this basically relates really strongly what the PE ratio is, so the current value of the share price, considering how quickly it's expected to grow within the next 5 years. And generally, a good price to earnings growth ratio, something that's less than 1, is normally considered cheap, and anything above that is generally a bit expensive, so you're paying a high price, regardless if it's going to grow fast in future. And in Jim Slater's book, he really likes anything that is less than 0.6. So that's obviously saying that the price is low, but there's good potential growth, so there's obviously good potential for the share price to grow really fast. So this can be a really good one to look into if you're looking at growth stocks and hoping to make some decent gains out of a stock. Okay, so now the next one down is price to sales ratio. And what this is pretty much the market cap, which is the sum of all of the shares added together, divided by the last 12 months worth of sales. Generally that pretty much means the revenue, so how much money the company has taken in. And this is seen as a preferred alternative sometimes to trailing PE to some investors. Because the thing is that PE ratio obviously uses earnings, and earnings can be a little bit manipulated by the companies. For example, when they're buying back shares and stuff like that, just to kind of make the earnings look better so they have better ratios, so investors want to invest in their company. And so just going for sales, so the revenue, that's much harder to mask, so it tends to give a bit more of an accurate representation of the money that's actually coming into the company. But then the thing is, this is sometimes useful for some companies, but then not so useful for others, so just like all of the other ratios on here, I'd take it with a pinch of salt, and just know what's good and what's not, relate it to the other companies to see if it's cheaper than those ones, and then just look at all of this in general to get a good idea of as to whether it's cheap or not. And so for price to sales ratio, generally something that's less than 1 is considered on the cheap side. And like I said, none of these ratios are perfect. And the thing is with price to sales ratio, it also uses the price, so the market cap. And the problem with this is that not accounting for how much debt the company has, so sometimes you could have a really high priced company that looks really good because they're huge, but the thing is they might have a lot of debt behind them. For example, if you owned a house for £100,000 but you had a £80,000 mortgage on that, then that would mean you only own 20% of that actual house, so it's a bit like that in a company as well. If you have a company who owns a huge amount of assets, but if most of it is all debt, then it shouldn't really be counted as the whole value of the company. So that's why there's also an alternative here, which is the enterprise value to revenue ratio. And this is very similar, but instead of the market cap, we have enterprise value, which remember is the market cap plus the debt and minus the cash. So obviously now we're accounting for the debt within the company. And this one can vary a bit between companies, so the best one to analyse this is actually just relating it to other similar companies within the sector to get an idea as to whether it's cheap or not. because different companies will have different models and they'll take on different levels of debt. And so now we've got price to book ratio. This one's slightly different to the others because it's not so much looking at the actual income of the company, it's looking at the price compared to the actual size of the company. So how much are you paying for how much company there actually is? So this ratio is worked out by having the share price and then dividing it by the book value. And what the book value is basically just the net worth of the company. So that means the assets minus its liabilities and then divided by all the total shares. So that tells you for every single share of that stock, how much in dollars is the company worth. So then obviously once that's divided by share price, that means how much for every $1 you pay of share price are you actually getting back in company. So if the price to book value were to be 1, that would mean for every share you're paying, so obviously the share price for Facebook right now is $268, $269. And so that would mean if you had a price to book value of 1, that would mean for every $269 you are paying for the share price, you are owning $269 of the actual company in terms of its fair share of that company. And generally 1, and you can probably get away with 2, which means that you're paying twice the price of the actual value of the company, is considered a fairish sort of price. And obviously less than 1 is brilliant, because that means you're paying for less than what the actual company is worth. So you're getting a premium. And then much higher than this, Facebook isn't too bad. So I've seen it way higher before, up in the hundreds. It's slightly higher, but that's because Facebook is more of a less asset-rich company. It's an online software company, so it's not going to have lots of assets in the first hand. So most of their money is going to come from the advertisements that they do and less from the infrastructure. So that is a slight flaw of price to book, because it doesn't work for all companies. It's mainly useful for large asset companies who need lots of assets to bring in their income. So for example, like utility companies. But generally the price to book ratio is much more useful for a company that uses lots of large assets to be able to make their money back. And then the final value here we're going to look at today is enterprise value to Ebitda. And this effectively tries to address all the flaws that are seen in the trailing PE ratio. The thing is that the trailing PE ratio uses share price, which is essentially a smaller version of the market cap. And so this is changed here by using enterprise value, which obviously accounts for the debt, so trying to get a more true value of what the company is worth. And then Ebitda, Ebitda, which stands for earnings before interest, tax, depreciation, and amortization. And these are basically all the things that are seen to be taken away before you actually get to the earnings, so when you have earnings per share for the PE ratio. But none of these things are completely relevant to how the company is actually making money, because different sectors and different individual companies will have different ways that they get taxed and stuff like that, because they're all working and operating from different countries and using so many different systems, so the earnings might not be given a true reflection of how well the company is actually doing. So this one's just generally basically trying to be a more nitty-gritty, get into the deeper version of how well the company is actually doing. So this is another good add-on just to look onto, looking at all of the others and assessing the PE ratio. And generally for this ratio, typically 10 or less is considered cheap. And so here we are, that's basically covered the basics of all of these values. And I know I did go through how you work out all of them, and obviously you don't need to really worry about that too much if you didn't quite understand it, because if you go onto Yahoo Finance, they'll all be here anyway. But I think it's great if you can just understand where they come from, so you know which one means what, and if you're looking at a specific company, you'll know which values to give more weight to as to which ones are more relevant. So remember when I said earlier how once you understand the numbers and what they all mean, you'll be able to just glance at it and get a quick overview of whether the company is worth it or not. So basically looking at this, we can basically see that from all of these values that I mentioned earlier, we can say that Facebook is slightly overpriced now. So it's not super overpriced, obviously looking at the peg, it's just over 1. So it won't be too bad, but with the price being so high, that means a lot of these future profits are already counted for, because the price is already high compared to what the future profits might be. So this would mean that you can probably expect less growth in terms of the share price compared to how fast the profits grow. And trust me, trailing PE can be crazy high sometimes, and so trailing PE at 26 and 4p at 19, I wouldn't be too worried about this. You could still validate trying to buy this, because in the long term it's a good solid company, and And you'd obviously have to take in consideration of all the other values about this company to see if it's worth investing in. And trust me, there's a lot worse ones out there. If we look at Tesla right now, I mean, come on, look at the PE ratio here, 1,330, with a forward PE of 157. So obviously you can see that that's a massive drop from what the earnings are expected in the future. But still, the forward PE ratio is 157. That means even considering what the future earnings are going to be, the PE ratio right now is still super high. So that means a lot of this future growth that obviously the company is more than likely going to have, it's a great forward-looking company. But this price to earnings ratio is still super high. So in order to justify the share price getting any higher, you'd still have to keep inflating this PE ratio, which doesn't seem super sustainable. So if I see PE ratios like that, I normally stay well away. Even though you see some figures like the PEG, obviously that looks pretty good. That's because there is expected lots of growth with Tesla. But all the rest of the figures here are just crazy high, so if I see companies like this, I'd stay well away. So obviously now, going back to Facebook, this doesn't look super bad, does it? So yeah, anyway, from the quick glance, Facebook's slightly over expensive, and this could impact how much the future gains go in terms of the share price. But it's not bad, it's not dangerously high like Tesla. So those are the valuations, those are the main ones you want to look at, and I hope you can understand all of these ones now, and just give them all a good general look. Don't count just one, because you could easily see, like we saw, Tesla had a great PEG ratio, but all the others were super high, so you want to take it with a pinch of salt and take into account all of these, and make sure you relate them to similar companies within the same sector, just so you can get a good idea of what is a good value ratio for that certain sector, because all companies are run differently. And once you do that, you'll be able to get a good quick glance of how to value a company within seconds, really. So now, obviously, that's the one part of the statistics section. I just want to run really quickly through the rest of it, just so you can understand the important bits, I think, on this. And then we have profitability, so the profit margin. Obviously, the higher the profit margin, that's great for a company, because it means the revenue that they're incoming, they're turning most of that into profit, because they are keeping their costs low. So generally a higher profit margin means a better run company with less risk involved, because it's a lot easier to grow a company with a high profit margin, and they have a lot more room for error when they're trying to stay profitable, even in difficult times. And this relates perfectly onto the return on assets and return on equity. And I want to turn your attention to mainly return on equity here. Return on equity is largely regarded as a really useful tool to look at in terms of trying to analyze a company. It is also noted to be one of Warren Buffett's favourite indicators for looking into how worthy a company is to invest in. You know Warren, that super successful investor that people keep mentioning. So equity of a company is basically the net worth of the company. So its assets, all of its assets, everything it owns, minus its liabilities. So any financial obligations it has, so anything that it's borrowing money from the bank and that is worth taking away from what the assets are, then you'll be left with what the total actual worth value is. And then so equity can be worked out. Now we divide profits by equity to get return on equity. This basically means how much profit do you get for every piece of equity of the company that you have. So from the size of the company, how much profit is it making? Generally, the higher the return on equity, the better and more efficient the business is. And this is a great thing to look out for, because if you've got a high return on equity, if the company were to grow or invest and build its business somewhat, it means that its profits are going to increase to a higher degree, because its percentage of return from that amount of business is going to be much higher than something with a smaller amount of return on equity. Now this can vary between company to company, so some sectors you wouldn't expect a high return on equity, so a company that's very asset intensive, like an oil company or something like that. But in general, we want to look for companies with a return on equity of probably larger than 10 to 15, and above 20 is brilliant. And that will mean that the growth of the company is going to equal lots of growth in profits too. And obviously, like we've seen before of the ratios, the higher the profits, the more well valued the company is. So that means the share price is likely to grow. And now, the next section here, well the next three down here, are just general briefs of the financial statements. And these are basically what I'm going to dive into next week. But just quickly explain which each financial statement is. And we'll look into the actual proper financial statements next week so you can understand them. So the income statement is basically a sheet that the company has to put out every year to tell you all the money that's going in and all the money that's going out of the company. So it's revenue and all the costs that it has, and so to find out whether it's profitable or not at the end of the year. And then the balance sheet, that effectively works out the health of the company. So all its assets minus its liabilities, and is able to cover the costs of all its financial obligations each year. So a company with large amounts of cash and not too much debt is considered very healthy, and that's a really good thing to look out for. And I should go into more depth in that in video 4. And then the cash flow statement. Cash flow is super important, and this feeds slightly off the income statement, but it's basically saying how well is the company able to convert its profits into cash at the end. Having a company with positive cash flow is absolutely essential. And then these last bits, this is stock price history. This you can pretty much just find out looking at the charts, so I won't worry about that too much. Then share statistics. This is all just different things about who kind of owns the stocks and are there any short sellers and stuff like that. And a lot of it doesn't really matter too much if you are looking to be a long-term investor in the stock, which I absolutely recommend, especially for beginners. But the two that I want to point your attention to here is the held by insiders and held by institutions section. Okay, so a large amount of the stock market is held by institutions. These are big hedge funds and big companies that hold large amounts of stocks for private investors. And that means when they buy and sell, they buy in huge amounts of bulk, so millions and billions of dollars. And institutions, I think, make up at least about 60% of the stock market's money in total. And so when we're looking at a particular stock, generally it's quite a good sign if the institutions haven't already gotten into the stock. So generally the lower the amount of institutions, it means that there's good potential for the stock to grow, because if institutions haven't found it yet, and if the company does well and then it starts to grab the attention of these big institutions, then lots of money is going to be pumped into that stock, and so then you have good potential for growth. So generally a lower percentage of the whole shares owned by institutions is quite a good sign, and 79 is quite high. Generally you want probably less than the average of 60, which is probably a good thing to look out for, but it's not the be-all and end-all. And then held by insiders. This basically means how much percentage of the shares of the company is owned by people who are actually working for the company in the management. And generally, having a large amount of the shares owned by management is a good sign, because it shows that the management really believe in that company, and so they're happy to put their own hard-earned cash into that stock, because they're expecting it to grow. Obviously, Facebook is a massive company with lots of money in it already, so obviously it's difficult for managers to have such a high holding into this. So you'd reasonably expect it to be fairly low for this, but the higher the better, because that shows confidence in the business. And then the final bit within the statistics section is dividends. Obviously this isn't super useful for Facebook because they don't pay a dividend, but what you're going to get here is the dividend rate and when you can expect the dividend to be paid. And so that's a brief overview of the statistics and the main section of when you first look into a stock on Yahoo Finance. I hope by now you have a good idea of what the valuations are, and now I hope you can just take a quick peek at the statistics area and get a good idea of what you're looking at. Great, so that's the first section of Yahoo Finance done. I hope you found that useful, and I hope you've learned a lot from this video. If it all seems confusing, don't worry, you'll get there. Just go over it a few times, and there's plenty of great resources on YouTube and books as well. I could recommend loads if you ask me. So just keep going through and keep trying to understand it, and it'll get easier eventually. And like I said, this is starting basic and gradually it'll be growing into slightly more complex stuff. Wherefrom in the next video, hopefully next week, we'll be jumping into these financial statements. I did mention them a little bit in this video. These are kind of the three main statements that the businesses have to put out every single year to kind of show all the numbers of how much they're earning and how much is costing them, and the health of their company, how much assets compared to how much debt they have, so how good solid run they are as a company. So this is the really nitty gritty of all the numbers and the details of the company. So I hope you'll find that next video really useful. So make sure you stay tuned for video number 4. And also, if you're interested in what I have to say, then you may also like my £1 a day challenge, where I'm taking you along on my journey of hopefully trying to reach financial freedom. I'm currently working on an e-commerce store, and I'm sharing every single thing I learn along the way, so hopefully you don't need to make the same mistakes as me, and hopefully you'll gain good information of how to run a business and just improve your financial life. I think I really want to help people, so I hope I can help over time. So if all that sounds useful, then please subscribe. I'd really appreciate that. Stick with me, and I hope I can help you over time.